What if I told you one quiet decision, made thousands of miles away, could ripple through your wallet, your investments, and the global economy faster than anyone expects? No press conference, no breaking news alert, just a single move that could choke global silver supply overnight. Russia has just banned silver exports, and most people have no idea what that really means yet. At first glance, it sounds like just another geopolitical headline. Another sanction, another trade restriction, something distant, something abstract. But silver isn't abstract. It's in your phone, your car, solar panels, medical equipment, and the power grid itself. It's one of the few metals that sits at the intersection of money and modern technology. And when a major producer suddenly says, "We're not selling," the shock doesn't stay local for long. Russia isn't the biggest silver producer in the world, but it doesn't need to be. Markets don't break when supply disappears completely. They break when the margin disappears. Silver already runs on razor-thin inventories. Unlike gold, most silver is consumed. It gets used up, lost, unrecovered. There aren't massive vaults overflowing with spare supply waiting to be unleashed. So when a country like Russia removes even a slice of export supply, it tightens an already strained system. Think about the timing. Industrial demand for silver is at record highs. Green energy alone is eating up more silver every year, especially from solar manufacturing. Electric vehicles use more silver than traditional cars. Data centers, AI infrastructure, defense systems, medical tech. All of it depends on silver. Now layer on a sudden export ban, and the question becomes uncomfortable. Where does the extra supply come from? This is where psychology enters the picture. Markets don't move only on facts. They move on expectations. If buyers believe silver will be harder to source tomorrow, they rush to secure it today. That creates a feedback loop. Higher demand meets lower available supply, prices move, inventories drain faster, and the fear spreads. We've seen this movie before. Nickel in 2022, natural gas in Europe, even toilet paper during a panic. The trigger is always the same: perceived scarcity. Russia's decision also sends a signal. Export bans aren't just about economics, they're leverage. They tell the world that resources can be weaponized. If silver can be restricted, what else can be? Palladium? Platinum? Energy-linked metals? Suddenly, manufacturers and governments start reassessing supply chains, stockpiles, and national security risks. That reassessment itself drives demand higher, even before physical shortages appear. And here's the part most headlines won't tell you. Silver pricing is heavily influenced by paper markets, futures contracts, derivatives, promises of silver, not always backed by immediate physical metal. When real-world supply tightens, paper markets can hold things together for a while, until they can't. When too many people ask for delivery at the same time, stress fractures show up fast. This is why a single export ban matters more than it looks. It's not just about Russia. It's about a fragile global silver system being pushed closer to its limits, because silver doesn't have much slack left to give. For years, the market has been quietly running deficits. More silver has been used than mined. The gap has been filled by above-ground inventories, recycled material, and stockpiles built long ago when demand was lower. But those buffers aren't infinite. Every year they shrink a little more. Most people don't notice. Prices move slowly. Headlines focus elsewhere, until something snaps. Russia's export ban acts like a stress test. It doesn't need to remove half the world's supply to cause problems. It just needs to expose how tight things already are. Refiners, manufacturers, and mints don't wait until shelves are empty to panic. They act early. They lock in contracts. They stockpile. And when many players do that at once, available silver disappears far faster than expected. Now think about who gets silver first when supply tightens. It's not the retail buyer. It's not the coin shop customer. It's large industrial users with long-term contracts and deep pockets. Solar manufacturers, defense suppliers, electronics giants. That leaves less metal for everything else. Premiums rise. Delivery times stretch. Suddenly, the spot price means very little compared to what it actually costs to get physical silver in hand. History gives us clues. In previous supply shocks, silver didn't move smoothly. It jumped, it stalled, it surged again. Volatility increases when confidence breaks. And confidence breaks when people realize the system depends on trust more than metal. If Russia's ban lasts longer than expected, or if other countries follow similar paths, the trust starts to wobble. There's also a political layer. Export bans tend to invite retaliation or imitation. If one country protects its resources, others ask why they shouldn't do the same. National interests rise, global cooperation falls. The silver market is global, but mining is local. Refining is concentrated, transportation is fragile. Disrupt one link, and the whole chain feels it. Meanwhile, investors start connecting dots. Inflation hasn't gone away. Debt levels are still climbing. Central banks continue to walk a tightrope. Silver, unlike many assets, benefits from both fear and growth. It's a hedge and a necessity. That dual role makes it uniquely sensitive to supply shocks. When demand from investors and industry collide, price becomes the pressure valve. And here's where it gets uncomfortable. Many assume silver shortages will be obvious. Empty shelves, headlines screaming crisis. In reality, shortages often show up quietly. Higher premiums, longer delays, contracts renegotiated, smaller buyers squeezed out. By the time the average person notices, the move has already happened. Russia's export ban isn't an isolated event, it's a catalyst. It accelerates trends already in motion: tight supply, rising industrial demand, fragile inventories, financial systems built on assumptions that may not hold under stress. And the biggest question isn't whether silver will feel the impact. It's who will feel it first, and how fast the realization spreads to the rest of the world. When that realization finally hits, reactions tend to be swift and emotional. Markets don't like surprises, especially ones tied to physical shortages. Traders scramble, manufacturers reassess production costs. Governments quietly evaluate reserves they haven't thought about in years. And everyday investors start asking a simple but dangerous question. What if there isn't enough silver to go around at current prices? This is where narratives flip. Silver stops being boring. It stops being an afterthought compared to gold. It becomes urgent. Media attention follows price, not the other way around. By the time headlines catch up, supply is already spoken for. We've seen it before. In moments of stress, silver doesn't ask permission to move. It gaps higher. It punishes hesitation. Russia's ban also forces a rethink about globalization itself. For decades, the assumption was that resources would always flow, that markets would stay open, that trade would smooth out shortages. But export bans break that illusion. They remind everyone that access to materials is political, conditional, temporary, and silver, because it's both strategic and essential, sits squarely in the crosshairs. There's another angle most people miss. Mining can't respond quickly. You can't flip a switch and produce more silver next quarter. New mines take years. Even expanding existing operations is slow and expensive. Environmental regulations, labor issues, energy costs. So when supply is cut today, the response comes far later. Prices move first. Production lags behind. Add to that the fact that much silver is mined as a byproduct of other metals like copper, lead, and zinc. That means silver supply doesn't always increase just because silver prices rise. It depends on entirely different markets. This structural quirk makes silver uniquely vulnerable to shocks. Demand can surge overnight. Supply cannot. So what starts as a temporary export ban can quietly reshape expectations. Buyers plan for less availability. Sellers demand higher prices. Middlemen hoard. And trust in just-in-time delivery erodes. Once that mindset shifts, it's hard to reverse. The real story isn't whether Russia alone can move the silver market. It is that the global system is so tightly balanced that even a single unexpected restriction can tip it. Silver doesn't need a perfect storm. It only needs a spark. And once that spark catches, the fire spreads faster than most people think. Russia's ban on silver exports may look like a minor geopolitical footnote. But in a market already strained by rising demand and shrinking inventories, it acts as a powerful catalyst. Silver EDS' unique role as both an industrial necessity and a monetary metal makes it especially sensitive to supply disruptions. Thin margins, slow mine response, and heavy reliance on paper markets amplify every shock. Whether the ban lasts weeks or months, it sends a clear signal that access to physical silver is no longer guaranteed. And in markets built on confidence, that realization alone can be enough to change everything.